What's up, everybody? It is the sexiest analyst that you will ever lay eyes on, Max Pitts from Trades and Gains. And holy snickle fritz, today we had a day in the markets. It was absolute chaos, and everything looked like it wants to be in red. Traders are panicking. Breaking news alerts on tariffs, and the Dow is absolutely plummeting. The S&P 500 has officially entered correction territory. The Dow plunged over 500 points, and Trump's fresh tariff threats are fueling uncertainty. Inflation is cooling, but not fast enough. Again, we need to be at 2%, y'all. And potential government shutdown looms. The question now is, how much worse can this situation get? But don't worry about it, because in this deep dive, we're going to get up in it like a thong in some butt cheeks, all right? We're going to talk about why are the markets crashing, first and foremost. That's the most important thing. That's what everybody wants to know. Why is this happening? Well, we're going to get to the bottom of it. As Mulan said, let's get down to business. Now, we're going to talk about what institutions are buying, because, we want to follow the smart money in this market. We want to see where the big boys are spending. Yeah, all right. And then we're going to look at some dark pool and options flow data as well. And again, this is going to be more of what is smart money betting on, and what to watch next, and how to potentially position yourself if you want to trade this clusterfuck of a market. Let's go ahead and break it down and get into it, folks. So let's start with the numbers, because that's, what, people lie, women lie, your baby mama lies, your mother lies, your father lies, but guess what never lies? The motherfucking numbers, dog. So the S&P 500 dropped 1.4%, which is now entering that correction territory. The Nasdaq also fell 2% as tech stocks weighed down on the index, because we had Nvidia, Tesla, and Apple all taking those huge hits, baby. And then we had the Dow Jones Industrial down 1.3%, which lost over 500 points, and it's marking one of its worst days of the years. I feel like we say that at least once a week about the Dow, because the Dow is ass cheeks. That thing can not catch a break. Now, the three main reasons for these sell-offs, folks. We have Trump's tariffs chaos. A new 200% tariff on EU wines and spirits is in response to European counter tariffs. Like, why? Why? Just why? 200%? Come on. We also have the EU and Canada retaliating with their own tariffs as well. And the Senate is poised to block a bill to avert a government shutdown. This escalating trade war, coupled with worries over government shutdown, set to begin this weekend if the Senate doesn't act, adds another layer of uncertainty to an already volatile market. We also had inflation data that came in cooler, but the market doesn't give a flying fuck. PPI data showed wholesale inflation was flat, but investors are shifting focus to recession fears. By the way, that's not shocking, because if you go and look at one of the articles we posted today on Trades and Gains, we talked about how retail is in a huge correction zone. Again, this is going to come down to consumer-based brands that rely on fucking consumers, but the consumers have low discretionary spending. They don't have consumer confidence is down. Everybody's broke as fuck, and people don't want to spend money on shit. So what do you think's going to happen? And then on top of that, these companies are going to have to charge more because we got tariffs coming on. Like, the math ain't mathing. Like, you can't go pay for something in cash and say it's free at this point. It's game over, folks. And this isn't... Wait, hold on. We got even more. A looming government shutdown. Again, the Senate Democrats are blocking a Republican spending bill, raising fears of an economic slowdown here. This isn't just about inflation anymore. It's tariffs, political instability, and economic slowdown fears, all hitting at the same time. Now, again, that inflation data was a mixed bag. We had 3.2% annually in February, a slight improvement from January's 3.5%, but still above the expectations of 3.3%. On a monthly basis, prices were flat, signaling the upward pressure. Now, it's not as hot as it's feared, but these concerns are going to remain. We also have a correction debate. The S&P 500 is finally in correction territory because it's down 10% from its high in February. However, research has shown that this is a fairly common aspect of the market, and it doesn't always lead to a bear market. In fact, since World War II, there have been 48 corrections in the S&P 500, but only 12 of them have turned into bear markets, which is a 20% decline. Now, 75% of the time, that means this is not going to become a bear market. Historically, bear markets are rarer, but can follow prolonged corrections as well. And volatility is normal in early and post-election year, but investors need to stay calm. Don't fucking panic yet. Just sit. Don't even look at your portfolio if that makes it easier for you. Just don't do that. We also had UiPath, which slumped after poor guidance. For individual stocks, they fell 14%. It lowered its revenue guidance. People. If it's one thing I can teach you about earnings reports today, it is this and simply this. You could beat revenue, you could beat EPS, but guess what? If your outlook is dog shit, investors will tank the stock. People will sell. People will panic because it's great. You beat EPS this quarter, but what's next? What are you doing next? That's what people care about. What is going to happen next? That's what they want to know. So you got to keep that in mind. Bank of America also downgraded them to underperform, which is never a good sign because that means that, it's not a good sign, guys. This disappointing outlook has raised concern about the broader tech sector and its ability to navigate the uncertain economic landscape. Again, AI spending is down, so that is not a good sign. We also had fast casual food stocks take a hit, like Chipotle, Shake Shack, and Kava. They're down 5 to 10% in March alone. However, some analysts are calling the sell-off overdone, pointing to strong consumer sentiment and demand for chains like Chipotle and Sweetgreen. Granted, consumer sentiment has not been strong, so I don't know where they're getting these numbers from. But moving on, Tesla also slid. We saw a 3% dip here with the broader market correction deepening. The EV maker's stock has already been down more than 30% over the last month due to sliding vehicle sales and criticism of Elon Musk's political involvement. The company's stock has lost all its post-election gains and is now on track for its worst quarter since 2024. With Tesla's stock under pressure, investors are increasingly questioning whether the EV giant can continue to maintain its market-leading position with these mounting challenges. Yeah, light that up, Elon. Now, let's go ahead and dive into our options flow. Now, looking at Investor Central Club, it looks like this is what institutional traders were looking at today. We had SPY 530 puts for April 2025 with $59 million in volume. We had QQQ with 465 puts for April 2025 with $38.8 million in volume. And we had Tesla $200 puts for April 2025 with $24.8 million in volume. Now, some of the bullish plays we saw, we had NVIDIA $1,200 calls with 19 million in volume. That's crazy. I feel like that's not right. It has to be 120. But with dark pool data, we had 991 million in dark pool prints of IEFA, international ETF, that is. We had 874 million in VU and IVV S&P 500 ETFs. Is this defensive positioning? And we also had massive block trades in Tesla, SPY, and QQQ, signaling institutional risk-off sentiment. Now, when you see huge dark pool prints in ETFs, it means institutions are rotating out of individual stocks and into index funds to hedge risk. That's a classic sign of risk-off positioning. Now, talking about some of the notable flow we had today, again, SPY, we had $72 million in overall flow with 13.24 million in calls against 59.62 million in puts. QQQ, we had 44 million in total flow with 6 million in calls against 38 million in puts. That's a very skewed number. We may wake up to a red day tomorrow, folks. I promise you we probably will. Tesla, We saw 36.79 million with 11 million in calls versus 24 million in puts. Nvidia actually flipped to green today, it looks like. We had 36 million in total volume with 19 million in calls, 17 million in puts. Again, we're going to always see a very almost 60, 40, 55, 45 type situation with Nvidia because it's really a risk off at the end of the day and people hedging against their positions. IWN had 23.82 million with only 412,000 in calls, but 23 million in puts. So I hope you guys wake up happy tomorrow because that might be a good payday because IWM is absolute dog shit. All right. HYG, we had 12.43 million in calls, or not in calls, in overall flow with only 611,000 in total calls versus 11 million in total puts. Now, BAC and Microsoft both ended the day green. BAC had 8.6. Oh, wow. These are two very skewed. We had $8.86 million in calls on BAC and 6.93 million in Microsoft with 6.93 million in calls. Now, looking at some of our dark pool feeds here, let's go ahead and refilter this. We had, again, we had that IEFA print, VOO, 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 IVV, IVV. We also had some SPY here at 760 million for 1.379 million shares total at the 553 price. Wow, that is interesting, folks. Interesting. If we keep looking down here, we have SPY at 551. So it looks like traders are either offloading or are looking to reposition themselves into ETFs from those individual stocks. Anyways, talking about what's next, where do we go from here? There are three major events that will determine what happens next. We have the CPI report. Inflation is cooling, could give the Fed room to cut rates earlier, stabilizing the market. If CPI is hot, expect more downside. Trump's next move on tariffs. Will Trump double down on the retaliatory tariffs or what? Like, what's going to happen? Because more tariffs equals slower economic growth, which equals more market pain for your average investor. And the Federal Reserve's response, will Powell finally step in to cool the markets? If we drop another 5 to 10%, expect verbal intervention from the Fed. The bottom line, volatility is back, baby, and this shit is not going anywhere, and it's not for the weak of heart. So how do you play this volatility? Let's go ahead and break it down. Bullish plays, if the market stabilizes, NVIDIA is a strong AI play, and it's still demand for semiconductors. It's still going to be that golden star. Now, next thing up is going to be GLD. Safe haven hedge, and it's pushing new highs. We have VIX calls, the volatility index. If the market keeps dropping, VIX will rise. And bearish plays, we have the S&P 500. Downtrend is confirmed currently. We have Tesla puts with weak demand plus bad sentiment. We have retail stocks, XRT puts, with consumer spending completely slowing down / falling off. The market is at a crossroads. If the Fed steps in, we could see a short-term bounce. But if tariffs escalate and the shutdown happens, we could be in for more pain. Either way, stay sharp, stay hedged, and trade smart. Something bigger? Or what do you think here? Are we just in a dip? Drop a comment below and let's discuss. Don't forget to like and subscribe for more real-time market updates. Until next time, I'm your host, Max Pitts. This is Trades and Gains. I will see you all in the next one. I love you. Mwah.